Hi, welcome back to another interesting video on daily model using swing points, the fourth day candle. So here is the model I use, and I usually start from the daily time frame. So from the title, we can see that we have swing points, and whenever you see a point formation is an indication that price is going to reverse. So this model is basically trading the continuation after a reversal. Now we have this chart and this is the daily time frame. So I will be demonstrating how you will identify a swing point in the market and also how you will be able to trade the fourth day candle in the swing point. Like I've said earlier, that the swing point is an indication that price is going to reverse. So whenever you see a swing point formation, you should know that something is about to happen in the market. So let's look at what is a swing point. Now, I'm going to use this chart, like I've said earlier, to explain how the model works, but let's understand what is a swing point. Now, a swing point is a three candle pattern. Let's say, for example, we have this swing high. This is a swing high, and this is a swing low. So there are a lot of swing high and swing low in the market, but you have to be specific to the kind of swing high and swing low you are identifying the market. Most importantly, you have to identify swing high and swing low that will move towards the direction of the areas where there are liquidity in the market. For example, we see this swing low, and because there is an area of liquidity at this point, and we see price has taken out liquidity here. And we see this swing low here. It's an area of liquidity. Price went and took the liquidity here at this level. So when price took this liquidity, it was, generated or facilitated by a swing high formation. And this is a swing high formation. And we see price coming to take out this liquidity at this level. So what is a swing point? Like we have identified here, we have this swing high here, and this is a swing point. Why? Is because we have a three candle pattern. So if we are to name this candle, we have a candle one here, this is a candle one, and this is the candle two, and this is the candle three. This is the candle 3. Now, the candle 2 is always the candle that creates the point. Like we've said, swing point, that means it has a point. Now, the candle 2 is the one that creates the point. And on the left of the candle 2 is candle 1, and on the right is candle 3. So now, the candle 1 and candle 3 are candles that are lower than candle 2. If you look at it, this is the high of candle 1 and this is the high of candle 3. And if you look at it, the highs are lower than the high on the candle 2. So when you see this in the market, is what we call a swing high. Now for swing low, we have this swing point here as the lowest point among the three candle. Now we have candle 1 on the left and then candle 3 on the right. So this is candle 3. Now we have candle 2 in the middle. Now if you look at it, the candle 1 and 2 is higher than the candle 2. So if you look at it, this high is higher than this particular low, and this low is higher than this particular low on the candle 2. So we have a swing formation that is a swing low formation. Having looked at what is swing high and swing low, let's look at what happens if a swing high or swing low is about to form. And basically, you need to identify reactions in the market, especially when swing high and swing low is about to form. Now, I want to use this swing high as an example. We said that this is a swing high, and we have price has formed this high. And when price was about to create this high, to have a swing high, we see the price reacted. We see this doji candle, which is a price reaction, and where's price reacting from? Is reacting from this other block. So not just that price has reacted, we see price closing inside the previous range. Now, when price close inside the previous range, we have a likelihood of swing formation. So what you need to do is that you anticipate the next candle should be what? Should be bearish. Why? Because we see price reacting and then closing inside the previous range. Now the previous range is from this high to this low. So this is the previous day range, and we see price reacted and close inside the range. So it is expected that the next candle will be bearish because of the attitude of price at this particular swing formation, the attitude of price. And we see that the third candle is bearish. Have to also mark the equilibrium of the third candle. If you look at it, the third candle started from this high to this low. And the EQ is this. This is the EQ, the midpoint. Now you have to also mark the EQ, which is the equilibrium of the price level. Because we said that we want to be selling or buying at day 4. And then we have day 1, day 2, and day 3. And day 4, we want to be selling. But look at what happened here. If you look at day 4, is a sell and a buy. Why? Because the market opened at this level and sold, and also what? Bought. But using our EQ level, which is the equilibrium, is not yet tapped by price, which is by day 4. If you look at price did not come into the equilibrium in day 4. So here we don't have a trade. Yes, we don't have a trade because price has refused to come close to the equilibrium or tap the equilibrium or come above the equilibrium and then reacted and continue selling. But we see price failing to come to the equilibrium. We don't have a trade on day 4. Here, let's look at this. If you look at this particular example here, we've seen a swing formation because price sweep liquidity above this high, and we see price reacting, closing inside the previous day range. Where is the previous day range? From this high to this low, we have the previous day range, and we see price closing inside the range. So day 3, we see that price reacted and closed below the low of day 3. So now we are supposed to engage in day 4. If you look at it, this is day 1, which is formed by this swing high. This is day 1, day 2, formed by this swing high, and then we have day 3. So day 4, we are supposed to engage in selling. Now, what do we need to do is to mark the EQ, that is the equilibrium of day 3, and this is day 3. If you mark the equilibrium, we've seen that price has come to the equilibrium of day 3 or even beyond, but price has not closed above it. We see a price reaction. Now, if I remove this and mark this place as EQ, which is equilibrium, we see that price came to the equilibrium of day 4, and we see price reacted and then sold. Now this day 4 is the continuation candle. And also, if we don't have a swing formation at day 4, and also we have a draw on liquidity as shown in this chart, which is this particular low is a draw on liquidity, and price is here to tap, we should expect that the next day candle will be what? Will be bearish, considering that the 4 close below the 3. If you look at this, is the 3 low, and we see price has closed below it. So we are expecting price to continue to go lower to tap into the draw on liquidity, which is this swing low. And we see the 5 sold bearish. Now what we need to do is to mark the equilibrium of the 4 again. If you mark the equilibrium of the 4, if you mark it, you see that price came to the equilibrium before selling. So this is how you can actually use the swing point formation to identify your bias on day 4, which is the continuation candle. Now here is another example. We see price is consolidating. And why do we know that price is consolidating? Because we have an expansion, price expand lower, and after every expansion you expect price to consolidate, retrace, or reverse, and we see price consolidating. Why is it consolidating? Because we see price was in a range. Now price is internal to this low and internal to this high, so we have a consolidation. But look at what happened when price sweep liquidity below this low, and then we see price closing inside this particular range of this low. We see a swing formation at this level. Then we have a swing low here, and this swing low is formed by candle 1, candle 2, and candle 3. Here we have our candle 2, which is the swing low itself, and candle 1 on the left and candle 3 on the right. And on day 4, we're expecting to continue going bullish. But look at what happened. Price opened and went bullish. Price refused to come into the midpoint of day 3. If you mark here, you see that price refused to come into the midpoint of day 3. So here is the midpoint, which is the EQ, and if you put your line here, you see that price opened and went bullish, then came back bearish. Now when you see price is refusing to come to your midpoint of the tree, you should not participate in the price or in the trade, because there's every likelihood that price will definitely reject and come to the EQ. If you look at it, as soon as price reject, price came to the EQ and respected the EQ, creating another swing formation here, because we have a fair value gap at this level. So we see price coming to the EQ before buying to what? To take out the draw on liquidity above this high. So when price took out this high, if you look at it, we have a swing formation, and this is another swing formation here. We have the swing high formed by the 2 candle, and this is day 1, this is day 3. And if you mark the midpoint of day 3, you will see that price refused to come into the midpoint on day 3. What do you see? Price opened, sold, and price failed to come to the midpoint at day 4. So you don't participate, but at day 3 we see price coming into the midpoint, coinciding with a fair value gap, and we see price coming into the midpoint before we can engage. So we can engage in day 4 and day 5 depending on how price reacts at the midpoint of the 3 candle of the swing point. So this is how, guys, I determine my bias using daily swing points levels, and also this is the daily model. It's very easy for you to determine your bias using this particular model. So see you in the next video.